Large cap versus mid cap versus small cap, which makes investors richer? Have you ever wondered why some stocks are called large cap, mid cap, and small cap? Many beginners think this term describes the share price, but that's completely wrong. A rupees 50 stock can be a large cap company and a rupees 5000 stock can be a small cap company. The real difference is market capitalization. Market capitalization means share price into total number of shares. The bigger the market cap, the bigger the company. Today we will learn what large cap are, what mid caps are, what small caps are, examples of Indian companies, risk versus reward, which category is best for different investors. What are large cap stocks? Large cap companies are the biggest and most established businesses in India. These companies usually dominate their industries and have strong financials. They are generally considered safer than mid and small caps. Examples of large cap companies include Reliance Industries, HDFC Bank, Infosys. These companies have survived multiple market crashes and economic cycles. Advantages are more stable, lower risk, strong brand value suitable for beginners. Disadvantages: slower growth, lower return potential compared to smaller companies. Imagine a giant elephant. It is powerful and stable, but it cannot run as fast as young horse. That's large cap stock. What are mid cap stocks? Mid cap companies are businesses that have already proven themselves but still have significant room to grow. Think of them as the future large caps. Example of mid cap companies: BHEL, Indian hotel companies, AU Small Finance Bank. Mid cap companies often grow faster than large cap because they are still expanding. Advantages are higher growth potential, can become future market leaders, better returns during bull markets. Disadvantages are more volatile, higher risk during market crashes. Imagine a growing tree. It's stronger than a small plant but still growing rapidly. That's a mid cap company. What are small cap stocks? Small cap companies are the smallest publicly listed companies. These businesses are often in the early stages of growth. Some may become future giants, others may disappear completely. Examples of small cap companies are BLS International Services, Tanfac Industries, Kirloskar Pneumatic Company. Small cap can generate massive returns. Many stocks that become 10x, 100x wealth creators started as small cap. Advantages are highest growth potential, possibility of multiplier return, can outperform all other categories. But the disadvantages are higher risk, high volatility, lower liquidity, more sensitive to economic slowdown. Imagine a tiny seed, it can grow into a giant tree, or it may never grow at all. That's the nature of small cap investing. Risk versus return comparison. Category: large cap, mid cap, small cap. Large cap has low risk and moderate return potential, whereas mid cap has medium risk and high return potential. Small cap has high risk and very high return potential. A simple rule: lower risk is lower returns, higher risk is higher potential returns. But remember, higher potential returns do not guarantee success. Which one should you choose? If you are a beginner, focus mostly on large caps. They are easier to hold during market crashes. If you have moderate risk tolerance, combine large cap and mid cap. This balance offers stability and growth. If you have a long-term horizon, a small allocation to small cap may boost return, but never invest blindly. Diversification is important. A balanced portfolio could include 60% large cap, 30% mid cap, 10% small cap. Adjust according to your risk tolerance. Large cap builds stability, mid cap provide growth, small cap offer opportunity. The smartest investors don't choose just one category. They combine all three and stay invested for years. Because in investing, wealth is usually built not by chasing the hottest stock, but by staying invested in quality businesses and letting compounding do the work.